Good morning, traders and investors. My name is Roger Scott. Today is Friday. It's finally Friday. What a week it's been. It is December the 18th. We've got less than 2 weeks to go before the end of the year. Can you imagine the end of 2020? I think if you were to poll most people, they would say we want 2020 to be over. It's been a long year. It's been a very strange year. It's been a very unpredictable year, and most people just want it to be over. Now, it's Friday. What do I always say? Let's get into it right now. Now, looking at the futures right now, pre-open, we're going to be opening up in about an hour and 20 minutes or so. Looking at the futures, we are mixed right now. The Dow is already negative 10. Markets are vulnerable. I know I know what you're thinking. You're probably thinking to yourself, Roger, you've been a bear for the last few weeks and the market has been going straight up. It hasn't really been going down, but I'm telling you folks, I'm usually early to the party, but I'm usually right about these things, especially after what I'm going to show you right now. So again, indices are kind of mixed. There's really nothing going on right now. Yesterday's employment data was awful. I mean, it was awful, and the retail data before that was awful as well, which means what I was afraid of happening is happening. There's a huge spike in COVID. And most working people are not going to get relief. They're not going to get vaccines till next quarter, which means we have a complete first quarter of 2021, the cold weather, the flu season, the most vulnerable period for COVID without COVID vaccines, and unemployment rates are already near 900,000. So I know the stock market's near all-time highs, but I think we're going to have a little pullback, and I want you to be prepared for it. So again, I'm not really happy with what I'm seeing with the markets. I am seeing the Russell outperform right now, and I'm looking at the NASDAQ, and it's only up 1. So the market is vulnerable. Now, I want you to look at the put-to-call ratio. This is a ratio, and I've explained, for the most part, this ratio is neutral. It's like a rubber band, and usually the rubber band just kind of does its own thing. It just snaps back and forth, kind of does its own thing, and nothing happens. But sometimes that rubber band gets stretched out. And right now, that rubber band got stretched out, and it just keeps getting stretched out, and it can't come back. Just the other week, it was all the way at 0.65. Market pulled back down against us for a day or two. It came back up, and now we're again at 0.69. We're in a very vulnerable zone. Whenever we're below 0.70, that means the interest on the calls is very, very high. That means the market is getting a little too bullish, running a little too hot for its own good. When the market goes to about 110, let me expand this. When the market goes to about 110, 120, that means the market is getting bearish, getting scared. This is what happened during the crash in March that we saw. And here's where we were before the crash, right where we are right now. So again, the market is stretched out right now. I know that you're looking at the S&P and you're thinking, well, Roger, you keep talking about this, but look at this. Again, we made an all-time high again. Look at the RSI. Can't get to that level. Divergence, higher highs. Let me expand this. Higher highs, right? Lower highs. That's not pretty. As a matter of fact, if you look at the period before the crash right here, let me show you. I'm going to show you this. Look, price going up, right? Look at momentum levels. Do you see that? And then look at what happened. It's the exact same thing. I mean, look, momentum level gets higher. RSI keeps going high, overbought, but the highs are getting lower. Higher highs, lower highs. Higher highs, lower highs. It's not happening in the Russell, but it is happening in the NASDAQ 100. Let me show you so you could see. I'm not just whistling Dixie. So you see that? Higher highs right here. Let me just expand that. Lower highs. And again, higher highs, lower highs. Here, let me show you so you could see. I'm not just doing this for my own health. And what happens? Pow! And what happens? What I think is going to happen. And the put-to-call ratio is right here, right where it is right now. So we have divergence. The market it's not just the fact that we're overbought. That's nothing. It's the divergence. The divergence is telling us that momentum levels can't keep up with where we are right now. Now, I want to go through some global events. And again, unemployment, retail data was awful, and I'm expecting the second foot to drop. I don't think we're going to have a big crash. I think we're going to just hit the 50, maybe the 200-day line and start coming back. And I think it's going to happen in January if we don't get any aid from the Fed and central banks this year, which I don't think is going to happen. I think it's going to be a political move where Biden's going to want to take credit for the aid that America is going to get, and it's probably going to happen sometimes in late January, early February, from political perspective. But I'm not a big politician, so it may come earlier. But I'm telling you, the market is really high. It's overbought, and it's diverging, and I'm not happy about this. Remember Seinfeld? George is not happy. Anyway, put the call ratio, not happy about that either. Now, in terms of global economy, let me just give you the highlights. Unemployment claims were awful, even though markets edged higher. I'm just going to give you the real quick rundown so I don't have to read this. Investors hope for progress in Washington. Yeah, good luck with that. Towards new economic aid, and what did I just say? I don't think it's going to happen until January. Hopefully I'm wrong. Highest level of new jobless claims in 3 months. You hear that? Highest level of jobless claims in 3 months. We went to 885,000. That's bad. We dipped into the 600,000s and now we're back. Japan's central bank extended an emergency loan program by 6 months and left monetary policy unchanged. Investors have been waiting since before American president election for lawmakers to agree on new aid to replace unemployment benefits that are expiring. The loss in income undercuts consumer spending, which is why retail sale numbers were so low, which is why we're not going to get a Christmas rally. This is my whole beef with this whole thing. The loss in income undercuts consumer spending that powers the biggest global economy and demand for imports from Asia and other suppliers. That's right. If retail sales are low and if unemployment's high, that means GDP can't be high because GDP, our growth, our consumer growth, our gross domestic product is 70-75% retail sales. And if retail sales can't get it up, forget about it. Central banks again pledged to keep buying bonds until the economy makes substantial progress, which is the reason why markets remain near all-time highs. Still, the Fed has said it can only do so much to tide over the economy, and more financial support from Washington is critical. And folks, if we don't get that support, or if we see the COVID cases get above 1 million, and again, we're not expecting healthy people to get vaccines till second quarter of 2021, and that's a problem. I'm seeing downside. What do I think you should do to take advantage? We got to focus on things that could potentially go higher next year and are not as vulnerable. We already know the NASDAQ 100 is vulnerable. We already know the S&P 500 is vulnerable. The Russell, on the other hand, as I've been saying, is not as vulnerable. Why? It doesn't have the pent-up demand. Look, higher highs, not really much divergence. Not really anything great, but not much divergence. The point is the Russell continues to make higher highs, and it's now outperforming the S&P. So one of the sectors I believe that's going to rock and roll next year is going to be the housing market. The Fed is not going to increase rates. A lot of people are refinancing, moving into different areas because of this COVID. A lot of companies are allowing people to move to different states, take a little a haircut in pay, move out, take a 10% pay cut, but move and work remotely. And a lot of cities, a lot of areas are getting home sales. And a lot of commercial real estate money is moving into home sales as well. So commercial real estate's moving into residential real estate. A lot of people refinancing, buying homes, taking advantage of this new spike in home sales, and interest rates will remain low. And here is a stock that I like. Now, it's in the Russell 2000, okay? First of all, which doesn't have divergence. 2, building products. Louisiana Corp manufactures building materials, engineered wood. If you're building a deck right now, you're probably paying a lot more for wood. What do they deal with? Home builders and light commercial builders, not heavy commercial builders. 1-year return, 35%. Revenue growth, 5-year, 19%. Earnings, 188%. 5-year return, 109%. I like this stock, and I love the fact that it's in the Russell 2000 and in the S&P 400 and not in the S&P 500. Now, if you look at the stock, you will see that the stock pulled back, looks pretty resilient, and I would put a risk protection right here below this pivot, and I would possibly enter right at the 39, 10 level And if it goes below this level, I would liquidate. And if it goes above this level, so I would buy around 39, I would put a stop loss around 37. That's simple. And if you're buying options, just wait for the stock to get hit and then buy the option. But again, low risk trade, and we want to see it take out the high and continue making another step up. So it made a swing high, it made 3 days down, and then it's pulling up again. So again, buy above like 39.12 maybe, just a little higher on a buy stop. In my opinion, I'm just I'm just giving you my opinion. And again, put a sell stop liquidation at $37 per share. So it's a low risk trade in my opinion because it's not related to technology. It's in the Russell 2000, which has been outperforming the broad indices, and it's not diverging. So I like the Russell. I like home builders. I like artificial or wood type of stuff going on right now. I like basic materials a lot. Industrial basic materials, those stocks are a little safer. And again, this company, Engineered Woods, that's where the money is. I was talking to James West, who's building a deck. He had to wait a year because the wood prices were so high. I talked to Jeff Zaninieri, who's in Miami the other day. We did a live thing. He was telling me people are buying homes like there's no tomorrow. There's a lot of construction. He says it's hard to buy wood right now. I don't remember the context he was talking in, but he made that comment as well. Prices may be going higher for wood products as well because there's a lot of demand for that. So again, this company I like, LPX. I think it's a low-risk trade to potentially keep you out of trouble during the second half of December. Now, I've got something big for you. Now, I spend a majority of my time talking about how to reduce risk. You guys know that. I just talked about this trade that only had $2 of risk. And during these volatile times, I think you understand why, right? Because we don't want to erase those profits. We don't want profits to turn into losses. And a good way to decrease risk is by simply minimizing the time you spend in the stock market, right? Makes sense. In other words, get into a trade before a large move and get out quickly. And no day trading. I'm not talking about day trading, okay? Take it easy. As a matter of fact, Futures of Wealth head trader Lance Ippolito has just made a career out of these 24-hour trades. You see, he deciphers data from the options market and uses it to strike moments, literally moments, before a stock jumps or crashes. Works both ways, to the upside and downside. I love that about Lance's strategies. If you're tired of the market roller coaster and hate watching your positions plummet, man, I hate watching positions plummet. There's nothing like having a nice winner and then it goes into a loser. I hate when that happens. If you're frustrated, if you want a better way, click the button below and watch Lance explain and prove his strategy. He's made a career out of these 24-hour trades. I'm telling you, get into these trades before a large move occurs and get quickly out. In and out, no day trading, none of that crazy overnight margin, none of that crazy intraday margin. These are overnight trades, but you don't stay in the market for a long time. You're nimble, which is what you got to do in the current market environment. It'll help you reduce risk. It'll help you control your portfolio in a better way, in my opinion. Again, you got to check out Futures of Wealth head trader Lance Ippolito. It's Friday. It's time to hang out, learn something good, improve your trading, hopefully, and gain an edge in this market. And that's what my hope is for you. I want you to have an unfair advantage, and my hope is that Lance is going to give it to you. So follow the link below. Let Lance explain his strategy. You got to check it out. It's really, really cool. And I'll talk to you soon. Leave me some comments, some feedback, and have a great weekend. Bye, everyone.